price of gold is finding it difficult to escape its recent trading range between 1850 and 1930. Since the gold price hit its record high of $2,075 an ounce back in August, price action seems to want to break that lower level of support. For more now on the fundamentals around the price of gold, we're talking to a former City of London-based dealer and trader who's held senior positions at a number of high-profile precious metals companies like Johnson Matthey, the world's largest gold refiner, NM Rothschild and Credit Suisse. He also has a formidable record of predicting the price of gold. It's Ross Norman. He's Chief Executive of Metals Daily, and he joins us now on today's podcast. Ross, welcome. It's a pleasure to catch up with you again. And of course, it comes at a very interesting time. Seeing that new record high in August seemed to give the price of the precious metal a new life after having held that old record of $1,920 odd for 9 years. But since August, it's been a very noisy market with bulls and bears fighting hard against each other. How do you feel about the current gold price?
Yeah, it depends upon who you are, really. I mean, if you're an investor, then I think you won't be dissuaded by the recent price correction. 5-10% corrections are normal in a bull run. If you're a trader, on the other hand, and looking to make money out of gold, then you're right. The market's become very noisy. It's pushed higher. We saw that in the summer months with so-called Robin Hooders getting on in behind gold and pushing it to a record high before correcting lower, and another correction recently with the recent Pfizer announcement of a vaccine. So we've got a sideways trading market, which is frustrating for those looking to trade the market and looking for entry and exit points.
Let's look at this in the big picture. The entire capitalist market system, as we know, was tested to the extreme a decade ago when that last record high was made in gold at 1921, back in September 2011, I referred to earlier. Many say that the markets have never really been fully repaired, just that it's been given remedial surgery by massive stimulus of low interest rates and massive unprecedented amounts of bond buying. What is gold currently reflecting in the price? Do you think all that stimulus has yet to be priced in?
Well, I think the expectation, clearly the market was waiting to see what the outcome of the US election was. A Democrat win, which we are likely to see, is suggestive of a significant stimulus. They were talking of over 2 trillion of stimulus, plus a further 1 to 2 trillion in infrastructure spend, front loading, if you like, the investment in the US economy and hoping for a return in years to come. Gold bulls will look at those numbers and say, well, do you know what, is that really, can you really afford that? And is it pay downable? So to some extent, you're right. The market's looking at debt, and we were looking for the outcome of the US election. But for the last year and a half, and it's important to remember that gold's been in a bull run pre-COVID, we've had this gently rising bond prices and declining bond yields, such that you've got negative real yields on the 10-year. And of course, that's been going on for the best part of 40 years. And indeed, the US dollar has been in a cyclical downtrend for 40 years. So a weakening US dollar, lower bond yields are unquestionably the key driver for investors looking at getting into gold. Add to that, if you like, COVID and the stimulus spend. So for the investor, the person with a long-term view, gold looks extremely attractive. It just goes through periods of pauses, and we're going into one right now.
Let's focus a bit more on that long-term part of it. What is the long-term here? Because I can't see anything that's going to change the current situation. Yes, we're looking for a vaccine. That seems to be something that the markets obviously focus very much on. And of course, when that does begin to bear fruit and we do see economies pick up again, that presumably will then be even more supportive for risk assets such as the equity markets, for example, which of course has been one of the reasons as to why I think we haven't seen gold march any further higher, because people want to use that money, perhaps maybe feel it's better spent in the markets. And the equity markets, of course, let's face it, have been in a situation where there is no other place to go other than equities, which is partly the reason, I guess, is why they've been bid up. But how long do we have to wait before gold does start to pick up again? It seems to me like it's many months ahead from here.
Well, we saw 90% gain last year. We've seen 24% year-to-date gains. So there's no question that we're in a bull run, first of all. And those are reasonable gains. Not if you're a Bitcoiner, but for a gold market, that's a reasonable number. You pick up the point about the equity market. So I think there's a feeling that there's a disconnect between the real economy and the equity markets. And I think gold bugs know that. And the markets are being bid up on the equity side, and it can only go so high. I think the biggest concern for me for gold, really, if we're looking over the next 6-12 months or so, really relates more to things structural to gold, we've seen some epic changes in the nature of the gold market. Formerly, it was a sector run by Indian and Chinese buying. They were the number one and number two. Germany in there, number three. Well, that's been turned on its head. Those markets have been absolutely rocked partly by the higher prices. What's taken its place is ETF buying, and it's in the first quarter of this year, European institutional buying. In the second quarter of this year, US institutional buying, and it's off the scale. In the first 6 months of this year, we've beaten any previous year with over 1,000 tons of gold bought. But, and this is the key point here, the momentum behind that buying is far less. I'll give you a number, if I may, Jeremy. In the first half of this year, ETF buying was running at a run rate of about 125 tons a month. Well, in August, we saw 39 tons. In September, 66 tons. October, 20 tons. And November, month to date, minus 10 tons. So there's no question that this ETF buying, the thirst of the institutional investor, currently is on the wane. And I might add to that, if I may, the other key driver over the last 5 years is central bank buying. And again, if I may give you three numbers here. If you look back to the third quarter of 2018, okay, the best on record, we saw 253 tons of central bank buying. Q3 last year, we saw 142 tons. And Q3 this year, we saw minus 12 tons. So the key drivers, ETF buying and central bank buying, is certainly flatlining. But the positive to that is the price correction that we've seen, particularly with the vaccine, has stimulated buying in those long-forgotten markets in India and China, where gold has been trading at a discount, and it's now coming up to par with local London, telling you that the demand in the Asian markets is now finally responding to these lower prices and picking up. In other words, the market's got a floor.
Okay, so it's establishing this floor. So then where does it go when things do start to pick up again? And what's going to be the driving force behind that next wave up that you seem to be suggesting might happen?
I think we're going to flat line for a little bit, actually. We've tested the upside, and we saw that during the summer months. We saw that in August when we hit the all-time high. We've seen COVID, of course, adding fuel to the fire during that. We're now testing the downside to see how good support is around the 1850 level. And at the moment, gold seems to be quite well responding to it. We won't really know for a few more weeks to come because, of course, we're just going into Diwali, the seasonal period when we've got Indian buying. Indian harvests have been phenomenal this year. So, again, Indian demand should be good. But I mentioned, a 24% gain in dollar terms. We've had a 30% gain in Indian rupee terms, and it's a very, very price-sensitive market, that. So it'll be very interesting to see how demand is going this week and next week in India during the season buying. We've got Christmas coming up as well. So it's yet to play out. We've seen the correction on the basis of the announcement by Pfizer and Moderna. What I take away from that is when the announcement came out, gold went through a 6% decline. Okay, we see 5-10% declines during bull runs anyway, no big deal. But it's how markets behave under adversity that you really get a sense of the character of the market. Technicians will tell you that a market should bounce 50% when you have a shock to the system. Well, gold was trading at $1960 an ounce when the vaccine announcement came out. It fell $110, and we've only had a 25% recovery in the price. And since then, we flatlined, suggesting to me the underlying strength of the market is dissipated. And that's reflected in the ETF demand as well. In short, the market's supported by good Asian buying underneath the market, but the key drivers from the investors, the institutional investors on ETF, currently is also is settling lower as well. It suggests to me that we could be in for a slightly flat period of time with a run up to Christmas. Of course, January brings the inauguration of the new president, so that will be a different story again, looking longer term. But at the moment, I don't see gold going much higher or much lower.
If you can keep your head.
When all about you are losing theirs,
what possibilities might you see?
If you can see it, the world is yours to trade and invest. See it, IG it.
Let's talk a little bit about an incoming President Biden. You referenced that earlier on in the interview as something that you felt could change some things. Just, of course, this is very much related to the dollar. And when we talk about the price of gold, we talk about it in dollars. And of course, if you do get a weaker dollar, that tends to push the price of gold up. And of course, it has an effect depending on which currency you're buying it in anyway. So let's take a look at the dollar and your thoughts about that. Do you consider that as in a continuation of what you described earlier as a bear market? I mean, we've seen a lot of dollar value loss. Do you see a lot more of that?
Well, certainly institutions. I did a webcast recently with Standard Chartered, with HSBC, and I've seen reports from other leading banks, and they're all suggesting a lower US dollar forecast for next year, US dollar index on the US dollar index. Looking at a Biden administration, certainly I think we could expect to see a more consensual world, less geopolitical tensions perhaps, higher taxes, a reflationary economy, which is normally very good for gold. So in short, higher debt, and of course that will weigh on growth prospects in the longer term. I've looked at Democrat and Republican administrations since 1971. It's difficult to read. Actually, gold's made significantly larger gains during Democrat administrations, but there are some anomalies in the early 1970s and 80s to distort those figures. Broadly speaking, gold doesn't really mind which administration you have. But certainly with Biden, I think that we could see a more predictable trade policy, which would be good, higher debt, which would be good for gold, higher taxes, which will weigh on growth. In other words, if we end up with a split house with the Republicans running the Senate, as is expected, maybe some of the egregious expectations of the Democrats will be moderated by having a split house, and it won't be as bad as we expect. But you could view it the other way, which is gridlock. In other words, Biden won't be able to enact many of the changes he wants to push through. In short, it's a little unclear at the moment. It's a little murky. I smiled when I saw a reference to somebody saying, do you know what? This goes back to pre-election. He said, even if I knew the outcome of the US election today, I don't know how I would trade it. And I feel the same way, even though we know likely who's going to win this one. I think it's uncertain today whether we're going to have a gridlock situation, a mired political situation, or somebody who's going to push forward and generate growth through infrastructure spend. It's unclear today.
Let's return to this point you mentioned about Bitcoin. I mean, you talk about the rise that we saw pre-COVID in the price of gold being a fair race up the chart. But of course, as you say, Bitcoiners have far more experience of far more wild moves. Just in the context of Bitcoin, do we know any more yet as to whether or not people that had perhaps maybe thought they might like to get into gold are now getting into Bitcoin? Do we have any evidence to suggest that gold is now possibly something, not necessarily a secondary asset when looking for protection, but do you think that Bitcoin is taking some of the upside wind out of the price of gold because people are preferring instead to put it into something a little bit newer and a little bit more edgy than what is an old traditional sort of safe haven like gold?
Certainly JP Morgan have written an article recently to confirm that or take that view. I mean, they are concentric. If you visualize, if you will, a Venn diagram, there is overlap. They occupy a similar space. I would say that the level of overlap is relatively modest. Those that come into gold are typically people that are concerned about the broader macro environment. They're worried about counterparty risk. They're worried about solvency. They have a deficit of trust in certain institutions. Let's put it that way. Buying a Bitcoin doesn't necessarily alleviate all of those concerns. I think they share a lot in common. Where I think they compete, and I think they're different people buying different things, and for different reasons. Some overlap, but not a lot. I think where Bitcoin embarrasses gold, let me put it that way, is not only its price performance, which is astonishing, and just on that particular point, the rationale for that is, if you again visualize, if you will, for a moment, a sailing boat. It's got a keel and a large weight on the bottom. It's got a natural righting mechanism attached to it, and gold has got that attached to it. It's got scrap which comes back to the market in higher prices, jewelry demand which tails off, and price-sensitive markets become less efficacious, during high prices. So gold will correct itself during these big runs. Bitcoin doesn't have, in the same way as that, a keel, if you like, a righting mechanism that gold has. So gold will be more modest, but less volatile. But going back to the key point, where I think you've got this overlap is probably for headlines. Gold is a tiny market. It's 0.6% of global assets under management. And you hear gold against the dollar and gold against the S&P. The reality is you're talking, David and Goliath here. The gold market, if it were an equity share, and if you took gold production as its equivalent of market cap, will be a large FTSE 100 business only. And yet yet we're looked at, probably because we're an important barometer, but the truth is we're a small market. And what we rely on is the headlines and people like yourself talking about gold to give it coverage. And by giving it coverage, you get people interested and they buy or sell. So it has to work hard to be seen and heard. And Bitcoin steals those headlines effectively. It's sexier, it's younger, it's refreshing. And so there's competition, if you like, for eyeballs that Bitcoin steals from us. But I think as a gold man, I admire and appreciate the technology that underpins Bitcoin. And I think probably the real story in the future will be the merging of those two assets into one, where you have gold-backed tokens or the settlement of gold trades using ledger technology to make it much more efficient. So that's yet to happen. The best is yet to come, the fusion of those two important assets.
You mentioned that the investment community just have something like 0.6% of the total amount invested in gold. I was talking recently to Dan Popescu, who is a big gold bug, and he suggested you hold as much as 10% of a portfolio in gold. Do you have a rule that you stick to? Do you have a proportion that you always adhere to when looking at the allocation of gold over other investments in a portfolio?
Well, the way I would respond to that is I would ask you, what do you think the chances there are of a major problem in the global economy, bigger than you've already seen, such as significant devaluation in the pound? Okay, you've got creeping devaluation, it's called inflation. What are the chances that you're going to have a situation where we have a hyperinflation moment or a significant inflation? Let's call it double-digit inflation. And you and I hope may just remember that. We have seen it in our lives before. What are the chances of that happening, let me say, in the next 5 years? And if you said to me, Ross, I think it's probably 1 in 10, well, that's your answer, isn't it? You allocate 10% of your portfolio to gold. If you said to me it's 1 in 5, well, then your portfolio allocation should be 20%. So as an investor in gold, I like to try to not to respond to noise. Even COVID I would regard as noise. I would regard Trump as noise in every sense. Look at the broad world and take a photograph of it mentally once a year and say, how much do I like the world and trust it? And what does it look like to me? And if I'm taking a 5-year view, if you feel it's getting into a dodgy space, if you feel that the Democrats spend of maybe $2 to $4 trillion, which is a big number, over the next 2 or 3 years, is going to kill the US dollar ultimately, and maybe 5 or 6 years to come. If you felt that, then you should put more into gold than if you didn't, clearly. So I would just keep asking yourself that question. What are the chances of a significant correction in financial markets, collapse in the equity markets, or a run on the dollar in some form or fashion? It doesn't have to be catastrophic, but it has to be significant.
Yeah, of course. One final question. As I said at the top, you have a good track record of predicting the price of gold. We're at currently, 1890 at the moment, around about that sort of level. We saw that record high, as we spoke about earlier, over 2000 in the summer. What are your thoughts then, as we move up into that next phase of an appreciation for gold? Do you have any targets in mind?
Yes, I suppose really, as I've indicated earlier in this interview, really, is I think that we're going to flatline for a period, support at 1850, and I can see us challenging 2000 again before the year's out, but somewhere within that range, not challenging the all-time high. And I can see that continuing for a few months until the world gets itself back on track. We get post-COVID perhaps in the spring. Then the world will take another hard look at itself. And I think and I made this point earlier, gold wasn't predicated, or the bull run wasn't predicated on COVID. We've been on a bull run for 2 years now, and we typically have bull runs of 6 to 9 years. So we've got mileage to go. I just think we've got a period of flatlining ahead of us, and then a rally towards the second half of next year. And I think that we'll be back to the all-time high in the second half of next year and pushing through the $2,100 level at some point. The point is, you need to be patient. Gold doesn't always do what you want when you want it.
Look, we'll have to leave it there, but Ross, thank you so much indeed for your time. It's been a pleasure to talk to you. Thank you.
Lovely chatting, Jeremy.
That's Ross Norman. He's the Chief Executive of Metals Daily, with us today on IG's Trading the Markets podcast. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.